And it is shocking to me sometimes, like an awful pitch deck, and then the founder is incredibly sophisticated. And then there are other times where there's great pitch decks and there's not a lot of caliber or quality behind the founding team. So how do you go about it?
We have a saying that's team, 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 market size, the product or technology, and then the idea. So in terms of ranking, the idea actually ranks 6.
Interesting.
In that stack. And what it's really saying is that dominantly, more than 50% of that criteria will be the team. Why are you so obsessed about building this company? What is it going to take for you to build this company? And I know you don't have all the answers. Maybe you only have 10% of the answers today. But I'm willing to write a check to you because I believe in you.
What's the pitch?
They wanted to build a flying car, but the image I had was the Jetsons and the cartoons I used to watch. It turns out that they are basically now a commercial drone service. They're one of the 6 companies in the United States licensed to transport medical equipment and live organs across the state.
What? Wow, I love that.
You don't have to build a large team to execute your product. You can do it by yourself.
In the age of AI.
In the age of AI.
Hey founders, ready to match with your next investor? At lucidityinsights.com, we've built the Middle East's first Tinder for startup founders and VCs. Explore 800 verified VC and angel profiles, see who they're funding, and send your pitch deck directly, all in one place. Stop waiting for introductions. Make your own luck at lucidityinsights.com. And for a limited time, get 20% off your startup registration with the code TPP20 at checkout.
Hello, everyone, and welcome to this episode of the Perfect Pitch podcast. It's my absolute pleasure today to be sitting across from Vijay Tirathrai. I had to get it right, so I had to look at it. Vijay is the chairman and founding partner of Silkbridge Ventures, and he also brought Techstars here and was a part of that business for over 8 years. And so we're going to talk all about pre-seed, seed investments with this man, and we're so grateful to have you here with us. Thank you, Vijay. So let's start with some basics, yeah? Let's start with this pre-seed seed, how important that is, and what it actually means to be investable in a pre-seed seed stage. So you reviewed thousands of pre-seed applications since 2017. Now we're in 2026. What does investable actually mean at this stage?
Yeah, Erica, firstly, thank you for having me here. Interesting times.
Yes.
To be here at this moment, but...
And by that, I do also want to say it is wartime. We're 5 days into, let's say, the skirmish that is going on between U.S., Israel, and Iran at the moment. And there were missiles flying overhead a few days ago, which is very unusual for a place like Dubai. And here we are recording a podcast.
Yes.
I think that says a lot about Dubai.
It says a lot about Dubai, and I think we're very blessed to be having this privilege to be speaking. I was recounting about just a conversation this morning with my wife and about do we leave the United Arab Emirates to a destination that we can call it safe. Conclusion is that if there's one place on the planet that we can confidently say that this is the place to be in, where we know the leadership will protect and do the right things, as we saw very recently through COVID.
Yeah, absolutely.
The response to a crisis. We drew the conclusion that this is the place to be in. Hence, being here with you today is nothing more than speaks to the level of confidence and sense of security in spite of the crisis that's ongoing right now. So I think that should not be understated.
Yeah, I really want to echo that because this is the first podcast we're recording since, World War III is breaking out. And I don't want to laugh at the situation because it is serious, but I absolutely agree with you. I'm Canadian, and I've always had respect for my leaders, but over the last few years, the world is looking bleak in terms of leadership, and it's always amazes me. I just came back from the US. I flew back on last Wednesday, just in time. And I really think about how lucky we are here to have the leadership, to have really clear communication, communities that are coming together and saying, hey, let's not spread disinformation, keep calm, let's be prepared. But, we're safe here. We're feeling really taken care of. And I think that's brilliant.
Yeah, absolutely.
Yeah.
And I think, when we think about, investing, we think about founders. Often the signal that I look for is, do founders really have clarity around what is the real problem they're trying to solve? And are they passionate about that? I think too often when we think about pre-seed, in most recent years, there is something to be critical of, which is saying, how do we get a pitch deck out to essentially entice investors on an idea? But if the idea is not substantiated with an underlying real problem, it doesn't even get anything close to a screening or a second look from an investor's lens. And so for me, being in the business of investing in pre-seed companies for over a decade right now, one tends to develop a certain pattern recognition. Someone walks through the door, makes a pitch, or even as on a Zoom call, there is a degree of, within 2 or 3 minutes into that conversation, that this is not going to make it.
Swipe left or swipe right.
Swipe right, exactly.
Yeah.
There are occasions that I'm proven wrong. I can think of many examples. But you kind of know, and that comes from the voluminous interaction that one has with dealing with founders on a daily basis. And I need to underscore that it's not something that it's science that you can automatically determine what gets swiped left or right. It has to be a process of going through the interactions on a daily basis to develop the art of identifying those signals.
Yeah.
So there is a certain signal to noise ratio that how do you distinguish the more positive opportunities, whereas the rest is just noise. And to be masterful in that, one just have to be in the game on a daily basis. You cannot check in on those occasional deals when you feel that someone say, hey, you should look at this, or perhaps, at your own convenience. You have to be in the game on a daily basis to develop the sense, the sixth sense of basically determining this.
Vijay, let me ask you this. I'm sure there are hundreds of pitches that come across your desk every month. And in terms of differentiating between, and at the pre-seed level and seed level, obviously, everyone says it's really about the founder or the founding team. Of course, the idea has to make sense, but it's really you're backing people over a business because it doesn't exist yet in many circumstances. Maybe there's a MVP in progress. I'm curious to know, of the ones that, you say in 2 or 3 minutes, you can tell there's really something there. Is it a huge difference between the noise and that? Is it instantaneously, And I assume it's something of a science and an art mixed together. So the science is there's a couple of metrics you're looking at, maybe to some degree pedigree, the idea, the thought process and the cognitive ability of this founder or founding team. But then there's this art of like gut feel that you seem to be leaning towards, of like this instinct. What is that? If you can, I mean, it's a secret sauce to everyone, but what is it for you? What is it that you're really looking for?
Yeah, it's a great question. And I think when we say the gut feel, it's actually not woo-woo, something that you have a sixth sense by nature. It's practice. And you get through the practice by reviewing a lot of pitch decks and pitches and meeting with founders on a daily basis. But the sixth sense you get, or the signal you get to move in or lean into that prospect, is not necessarily a decision. It's just basically a mechanism to lean in. Because everything else has to be validated. Mm-hmm. So you might trust your gut, but it needs verification. So trust and verify. Simply put, that, if you were the fifth or maybe the 50th candidate walking into a room for a pitch, I lean into you, I'm getting that sense that you got something. But what I'm going to do after that is send me the materials. Let me check the market size, your valuation, your team, and what's their background, and so on. So that verification is non-negotiable. It has to be done. Mm-hmm. So it's not really a blind bet. There is some scientific applications in terms of processes that you have to go through. But the lean-in opportunity is really where the practice generates that sixth sense. And that's really what I'm trying to say.
Okay.
Yeah.
Let me take one step back, and I'm going to ask this for so many founders because, I speak to many founders every week as well that are just embarking on their fundraising process. And of course, their biggest pet peeve or concern is that they're sending out what they think is a beautiful pitch deck that very obviously explains what they're trying to do, and they're just not getting callbacks or messages back on any platform, whether it's the email or LinkedIn or on our platform as well. What is it about those pitch decks that really make you go, yeah, I'm going to take this call, versus others? Because what I have found is that I meet them regardless of where their pitch deck is at, because they've requested some sort of review. And so we do that. And it is shocking to me sometimes, like an awful pitch deck, and then the founder is incredibly sophisticated and can explain it really well, but they just don't have a great pitch deck, And then there are other times where there's great pitch decks and there's not a lot of caliber or quality behind the founding team. So how do you go about it?
Can I be honest?
Yeah.
It's got nothing to do with the pitch deck.
So what does it have to do
So there's
with?
something else that happens around the pitch deck, and it's basically how you introduced to the investor, how you brought to me. And often if it's the whole spectrum will be, on one side being a cold call, you just send an email. The odds of that getting a response is probably 0.5%. To the left side of the spectrum, where you get someone who is mutually respected, and that's a warm introduction, I'm more likely to say yes because of Erica. I'm going to pick up the phone, or I'm going to look at the deck and review it. Because Erica is saying it, it has to be credible. So as an investor, really, the missing gap in that equation is what is the credibility link that supports the applicant or supports the founder with the pitch deck? If I can lock that credibility link into the value chain, then he has got a huge advantage. So that's, for me, the starting point. The challenge, I think, for a lot of founders is how do they go around in circles to get to me? Right?
Yeah, it kind of sounds like, back when I was in high school, everyone wanted waitressing jobs because they paid a little bit of tips on top of your minimum wage, right, in Canada. And but they would always say server experience required. And it was like, well, how can we get server experience if, they're only hiring people with experience? And in this case, it's the same. It's how do these people who have an amazing idea, who might even have an amazing team. They're really working on something. They're maybe sitting out of Nairobi, and they know that there's an investor here in Dubai that has all of the expertise that they need to get to the next level. But they don't have the pedigree, or they don't have the networks. There's nothing I hate more than an old boys club, and yet I understand that this is the way that the world works.
Yeah.
How do those people get through?
Yeah. So I think there is excuse the language, the lucky sperm pool of people.
Yeah.
And the rest of the world.
Yeah.
So the lucky sperm do get somewhere because of the pedigree of the college education or the family name, or they happen to be in the right network or neighborhood.
Mm-hmm.
And I think there's a lot of truth to that if you think about Silicon Valley as a ecosystem, as a community, as opposed to someone else outside Silicon Valley. Clearly you are in that network.
Mm-hmm.
And they're safe to be said in every ecosystem around the world. But I want to come back to the earlier conversation question around when you think about pre-seed and you think about what you're really looking for, there's a shift that's taken place, I want to say in the last 5 to 7 years than what it is today.
Mm-hmm.
Clearly, when you think about pre-seed, by definition, the idea doesn't really make much value in the equation. It is obviously the team. And we have a saying that's team, market size, the product or technology, and then the idea.
Team, market size, so the potential, the TAM, the total
Yes.
addressable market. Then?
The technology or the product or the IP.
Technology for deployment, okay.
How great your product is, how wonderful you designed that.
Yeah,
And then the general idea. So in terms of ranking, the idea actually ranks 6.
Interesting.
In that stack. And what it's really saying is that dominantly, more than 50% of that criteria will be the team. Now, when we think about the team, it's number one, you might have 2 or 3 co-founders. The team dynamics is really important because a lot of startups that come forward, they've just met maybe in the dorms in college, maybe for a year, and said, we've got a great idea, let's go out and build something. Mm-hmm. Or you'll be colleagues at work. All right, you deal the sales, I'll deal the tech. I'm sure we can do this better than this corporation. Mm-hmm. But when they're out there on their own without the support system, chemistry and dynamics is a real thing. Mm-hmm. And what I've seen is that when you think about why companies fail in the first 3 years, it's usually running out of cash. Number 2, poor product market fit. They might have a few false positive, like selling the first 100 units, but then shipping the next 100 units become a challenge. So that's, by definition, not a product market fit. But the third reason is because as stress and strain and fatigue settles down, then the real deal chemistry comes to play. I got family obligations, I'm running out of cash in the bank, this is not working out for me, or you're putting more hours than I do, and we see teams falling apart. Mm-hmm. And one of my biggest concerns as a GP of a fund is to make sure that the investments we make, the biggest asset is the team, not the IP, not the product, it's the team. That's a big. So are they well constructed from a skill sets? Are they balanced? Do they have the right chemistry? Do they have this right resilience from experience that we can see, proof of what they built in the past? Because my job is to identify those assets, being the team as a collective, and then invest, but also to nurture them because they need a lot of support. We can talk a little bit about the accelerator programs that we design to support them, but fundamentally that's the criteria. And of course, then you look at the talent they bring. Are they a PhD in a certain science and engineering field that they really have superior knowledge in terms of trying to solve a problem in the market, or just grit and experience merely by going out there in the streets and selling something? Are they able to hustle? And these are the things that really is important, because that's the only tangible thing that you can really pin on. Remember, these are pre-seed companies. There's no P&L. There's no balance sheet, right? It could be an idea that maybe the patent is pending. We don't know it's going to work in the market. So hence the overweight on the team in the construct of a startup versus a matured company.
Yeah.
Which you're looking at many more other factors, from financials, last 3-year track records, and so on. But the shift is this, Erica. What I notice is that we tend, even my days at Texas, we tend to put those emphasis on the team. Now we're looking for more velocity. We're looking for momentum. What have you done since when you woke up from bed and you say, I have this idea? And today, that could be in a year, it could be 12 weeks, it could be 12 days, it doesn't matter. From day one, you had the idea, what have you produced? And if you can demonstrate that we have momentum, like we went out to market, we fundraised, even on a
friends and family round.
Friends around the back of a paper napkin idea, or you close 2 customers even without a product, that's telling what you can do. That's what we'll lean into in terms of these guys got the
gusto
to build a company.
I'm curious if that velocity equation is also sort of compounding or becoming more important in this AI age, where it seems like people can vibe code and, build MVPs much quicker for a lot less capital. And there does seem to be this growing knowledge gap as well of those people that can utilize these AI tools that are, sometimes even freely available. Do you feel that AI conversation is accelerating this desire for velocity?
We're in 2026.
Yeah.
Every founder has to be AI native, period. Secondly, what AI means to me, it's not the technology, it's compression. It's compression of time, and time scales to execution, compression of work processes to get from A to B, and basically interoperability with multiple operating systems using automation or AI to deliver a product or experience or service. That's what AI means to me. It's a compression of all that. And so, in essence, it does eliminate a lot of service providers out there. People built technologies a decade ago. It's now completely irrelevant. Even 3 years ago. And so the thinking is that, that what AI is doing is essentially an automation tool to enhance and accelerate the solutions faster and eliminating a lot of inputs, whether it's human input in terms of coding, as you said, whether it's basically waiting for data to come back from the customer, if their data sets about how the customer's reacting to a product or a service, it's all instant right now. It's all happening in real time, simultaneously, concurrently. It's all instant. But ultimately, one thing has not changed. What is the real problem that are you solving as a founder? And if you use AI, which is naturally going to be the case, can you get that faster? And what I would like to see, can you build a moat around it? So there's a degree of defensibility that doesn't allow for your competitors to come in. And you can go into details about how you can build a moat, but it's not necessarily technology.
Okay, interesting. I'm also curious when you say, we're looking for, because a lot of investors say this, they say we're looking for founders that are solving a real problem, focus on real. And of course, that changes depending on what market you are in. Like if you're in Africa and you're in fintech, it's, less than 50% of the population is banked. There are real financial literacy challenges. These feel like real world problems. There are, here in the UAE, of course, real problems to solve or frictions to solve for, but there also seems to be a lot of superfluous ideas out there, things that feel good. Or, a couple years ago, I sat down with Chris Barton, who invented Shazam. And, he sits there and kind of says himself, is it a real world problem that I want to know what this song is immediately? And, we didn't really have a real commercial strategy at that point, but we just knew that it was revolutionary tech. And today it's on everyone's phones. So it's a real success, but it wasn't solving a quote unquote real problem. What's your thoughts on this about solving for a real problem?
Yeah, I think I would like to frame it as this. There are two realms when you think about problem sets. One realm is basically investor-led, which says, look, we have an investment thesis, and our fund is going to invest in renewables. Our fund is going to invest in data center or infrastructure for AI, et cetera, medical science, whatever it might be. And they have a defined thesis to say, based on research, based on demographics, based on momentum, we think the next 30 years, this will be a huge, massive opportunity, right? And so founders then coming forward to say, our solution is nibbling at a tiny part of that large marketplace, and this is how we're going to do it. So for me, that's investor-led based on a thesis. Then you have the other side of the room, which is founder-led. There's no thesis that they're responding to. It's more about intuition and insights. It's more like Steve Jobs and saying, there's a need for an, iPod.
Or a computer in every household.
Yes, something like that, right? And they think, okay, it's not really a real world problem, but it would be nice to have. But today it's $1 trillion enterprise because he's built something that has made people want it. Those instincts and intuition is founder-led, and not necessarily, and this is a really important message to founders, particularly in early stage, not all investors will buy into that. You probably will have to look to individuals who see themselves in you. Okay, I see a Steve Jobs in you. And I'm going to invest in you because I believe in you, not that I believe that product is going to work.
Yeah, I could see this.
Yeah.
I see this all the time, actually. It's like a chemistry between, and a mentor-mentee relationship between investor and founder. And they're like, I don't know if I believe in your idea, but you seem to believe in it, and I believe in you. So I'm willing to cut you a small check to try and make it work.
I hate to bring Elon Musk.
Yeah.
But 20 years ago, 25 years ago, he says, I'm going to transport humans to Mars and make it into a livable planet because there is a case for an interplanetary population.
Yeah.
People probably thought he's nuts. And he says he's going to do it in 25 years. But
It was also revolutionary. Yeah.
But see where SpaceX is today.
Yeah. Yeah.
It's extraordinary. And what I'm saying is that there's no investment thesis then, specifically as an industry,
Right.
that's investing in this. But the people who invested early is investing because it's Elon Musk. It's the entrepreneur. And what I'm saying is in this realm can coexist equally as the other realm, which is investor-led. And so back to your question about problem sets, it will vary on two spectrums. The Shazams will be entrepreneur-led.
Yeah.
The guys who are building out the next Anthropic or cloud, it's certainly going to be the investor-led.
Interesting.
Yes.
And as you look at the investor landscape here, because often I assume Techstars and even now in your business, you are the first check for many of these founders. And I assume that you've supported many of them to get their second and third and fourth checks to grow, the ones that were successful. And I'm curious, through your experience, walking through these investor halls of the region, what's the percentage here, do you think, that they're making? Are most of them, is 90% investor-led decision-making and 10% founder-led, or what? Or I assume it also depends on how many inspirational founders there are.
So I would answer this in two ways. The first is basically myself as a GP. And so myself as a GP, I'm biased towards an entrepreneur-led, a founder-led. Because I'm an entrepreneur myself. I built companies in the past, and I can relate and resonate with the entrepreneur across the table to say, I understand, I can feel the temperature on your body, so to speak, why you're so obsessed about building this company. What is it going to take for you to build this company? And I know you don't have all the answers. Maybe you only have 10% of the answers today. But I'm willing to write a check to you because I believe in you. That's me as a GP managing the fund, because I have seen enough patterns of recognition to seeing this is really an entrepreneur who can build something. But I'm also challenged, and this is a really important point, and to contextualize what I'm about to say specific with this region. In this region in the Middle East, North Africa, is that I'm wary that not all VCs are on the same page with me. And therefore, when I say I'm wary, I'm actually have to be very conscious to say that if I were to make success of my investments, I need to see what the off-ramp is.
Where the next check is coming from.
Where the next check is going to come from. And I almost have to engineer the success by saying, I want to invest in you, but I know that you're going to struggle for the next decade to raise the next check. And unfortunately, I'll have to give that check to someone else who I know there are 10 VCs waiting to invest in this in due course, maybe in 6 months or 12 months. And that's a conflict I have.
Fascinating.
Yeah.
I imagine that's why it's so important for startup ecosystems to develop that, kind of like the PayPal mafia or the Kareem mafia. The hope is that there is enough wealthy, players that want to invest back into the next generation of startup founders and go, hey, I've made a little bit of cash here. It's not a whole lot, but we're ready. We believe we can make more bets on the founder side.
Correct.
And are you seeing that in the last 10 years in this region?
It's beginning to happen, but I would say we're another generation away. Because there aren't as many success stories as Kareem.
Yeah.
Kareem is an exception.
Yeah.
But to be fair, the success of Kareem is only 10 years old. And so we have to give, a generation is 25 years. So we're in the first generation of the evolving economy that will eventually produce a number of billion-dollar enterprise that will create a mafia. So it's a slow and steady growth, and there's no comparison to what it is in the United States.
Yeah.
But the fact remains is that we have momentum.
Okay. Yeah, I feel very similarly
Yeah.
to that. The other concern that I hear from a lot of startup founders that even have been successful in raising funds is there seems to be this consensus that even though there's money to be found here in the region, if you actually look at a lot of the VCs and investors, they don't have deployable cash. They're sitting on a lot of cash that they're waiting to deploy to their own portfolio companies, or they're actively fundraising for their next fund and kind of keeping that sort of quietly under wraps that they're not actively investing. What is your take on this in terms of this region, and particularly like most of the capital sits here in Dubai with a lot of VCs and investors here in Dubai? I think when I looked at the data, in the last 10 years, if I look at all funding rounds across MENA, it doesn't mean they're Dubai-born startups, but they're Dubai-based startups. So they've moved here from Jordan, from Egypt, from other places, and they've moved here precisely because the capital is here to fundraise for them. And so kind of looking at the microcosm of Dubai's investor ecosystem, we can kind of get a feel for the region as well. What's your take on really capital availability? Is there real powder left in the market, or is there not enough?
It's a really interesting question. I don't think I have the perfect answer, but I might be controversial at the same time.
I love it. Let's go.
So I think in the first wave of VCs that came up in the 2016 to 2020, around about COVID, there was a lot of push and momentum and excitement in venture capital. There's a lot of free capital flowing around. Valuations are on the
high end,
very frothy, which peaked in 2021. So fundraising was not necessarily a challenge, supplemented by, particularly across the border with Saudi Arabia, there's been a lot of state-funded capital or fund of funds that went into VCs. So fundraising became a phenomenon that was what was unheard of a decade earlier, became materially very, very accessible and very possible. Now, what has happened since is that a couple of factors played out. One is valuations of tech companies, particularly non-listed equities, have not really rose to the occasion. So valuations are lower than what it was, say, 5 years ago, which means in the first fund, VCs were deploying capital at a very rich valuations. And even if there are exits, they were getting the capital back, but they were not getting the multiples they were expected. Assuming they were expecting a 4 or 5x capital return on capital, they're probably getting a 2 at best, maybe 1 at best in some cases. And so, by definition of that, raising a second fund becomes extremely challenging because LPs are saying, show me the performance. And what we see is that in the classic 80-20 scenario, 20% are very successful in raising even bigger funds because they were early enough and they really made good decisions on some of their companies that were raised and exited, which showed a very healthy track record, and hence they were able to raise a second fund. But the many are caught in that cycle where they've invested in rich valuations, companies in their portfolio aren't able to exit, and they're kind of stuck. So that is one thing that's playing out. The second thing that's playing out is that capital for VCs, capital as product, is in competition with public equities, with real estate. And if you look at all the magnificent 7 companies, they're doing extraordinarily well the last 7 years. So people are moving to private equity, secondary shares for those entities. There's competition for capital. The third factor I would say is that you're also getting a flooding of the market to some degree where there are state-sponsored programs and funds such as accelerator programs, incubators, where it's easy for a founder to join the program and get a $100,000 check, which in a way competes with the VCs who raise and have to show performance on those funds. And so this dynamics has been playing out in the last 5 years that's causing a lot of challenges in the marketplace. But I think here, sitting in 2026, it's eventually settling down. And what it's going to do, Erica, is going to separate the boys from the men in the process. So it's a healthy shakeup, and it'll probably right-size to the market that we're here in the Middle East. But that's the way it's going to be in the future. It's going to be tougher to raise capital. It's going to be tougher for founders to get a check. But it's actually a much balanced environment.
Interesting. Okay. And so it would be safe to say that we will see some investors fall off.
Yes.
Yeah. Just like we're seeing startups sort of fall off, or, some of these startups consolidate with bigger players eating them. Okay. Fair. Let me move on a little bit here. You've had 8 years with Techstars. It is considered a accelerator. You've mentioned this already. It's very different from a venture capital model. And I want you to talk a little bit about what you mean by that. And you have your own Silkbridge Ventures. You say you're focusing that on Asia as well. So I do want to dive into that. But you're wearing many hats. Talk a little bit about the many hats you're wearing. You're still a strategic advisor to Techstars, and you've started Silkbridge Ventures, and you also are the managing director of STS.
Yes.
Which is all about educating founders on exits and advising them.
Yeah.
Talk to me a little bit about these 3 hats you wear, how different these businesses are, or advisory capacities are, or investment capacities are for a startup founder. I like that from a startup founder perspective, though. They can come to you at any of these life cycles and probably get some interesting advice. It's
interesting you say that because, firstly, I actually retired from the role of managing director at Techstars in 2025 Q1, and having done multiple programs across the Middle East, namely in Dubai, Riyadh, and Abu Dhabi, and through those programs, by design, as an investment company, Techstars invests in a cohort of 10 companies at each program. So it's programmatic investments. And Techstars is the world leader in accelerator programs, which means it's a 12-week program that has, by design, has over 80 mentors, helping founders to shorten the learning curve. What might take them 2 years to get to awareness in the market and get access to market and raise capital. The 12 weeks is meant to design to shorten that learning curve through validation, quick validations by getting out there with the customers and investors.
And so for those people out there that are unaware of this, those people, maybe there's founders out there or wannabe founders out there, this is kind of a boot camp. I would say it's like an MBA for startup founders, where you have learning modules and you show up, is it to class every day? And you're kind of guided through this process of building your MVP or your pitch deck and preparing you for really testing your idea to see if it works.
Absolutely. And it is intense, so you can call it a boot camp. But the idea is that you build your company while at the same time accessing some learning modules that we've designed specifically for startups, as well as access to mentors that we've curated specific to the program, as well as you have an entrepreneur in residence, the managing director that's in program, who are all entrepreneurs, built companies, exited, raised capital in the past, providing you that 24/7 support to be able to make quick decisions. So you're never alone. And ultimately it all culminates to what we call the demo day, which is basically bringing investors into the room and where you can have a chance to pitch and raise capital. And so, and part of that is making your company becoming investor ready. And so that's the general idea of an accelerator program versus a VC. They don't have the capacity or resources to do all that. At best, what they could do is write a check. The GPs or the fund managers might be accessible to making a few introductions, might give them advice, but it's not scalable. because there's a limit to how much you can reach out to a number of people. But with this accelerator program, we are harnessing a whole community to support the founder. So it's not stretched on one individual being the managing director.
And can I ask you, what do you, in your view, is the difference between an accelerator program and an incubator program?
I think there has been an unfortunate dilution in the market. People are interchangeably using that. But the classic view is that if you are developing you're doing R&D and you're developing a patent or you're developing a product, you need to kind of be in the lab, testing it out and getting some early validations through scientific studies and so on. That's an incubator process. You're kind of nurturing the idea out. But an accelerator is basically taking a product to market and attaining product market fit.
Okay.
So product market fit, by definition, allows you then to have proof that you have a minimum viable number of customers out there that's coming back. The term we use is repeatability, which means they're purchasing on a regular basis. And in addition to that, you are scaling the number of customer counts. That is evidence that you got product market fit. People want your product. In the case of incubator, you're fine-tuning the engineering of the product. You might be designing something to get a patent out. But it's very research intensive, very development intensive. Accelerator has a lot of forward-facing sales, customer, market development elements to it.
Interesting.
And that's a key differentiation. And typically, fundraising for founders in the incubator will be more like grants, research money.
Interesting. Okay.
That people are willing to, not expecting to have a return on investment. Whereas an accelerator are real investors putting in money and they are expecting a return on investments.
Right.
Now, that being said, or truth being told, 9 companies will fail. But on a portfolio basis, that 1 in 10 will give you significant returns that covers your cost of operating and that cover the cost of the capital and give you enough profits to move on to launch a second fund.
Okay.
So that's the business that Texas is in. And similarly with Silkbridge Ventures, which is a new entity that I started with my 2 co-partners, both Sean and Rizwan, who are both venture partners, is undertaking the same idea, but we've evolved the product slightly into multi-stage programs, being the catalyst, the go-to-market accelerator, enhance fuel up. Different stages for different evolutions of the company's performance. And what's interesting is that we are now tackling Central Asia as a geography.
So these are the stands.
These are the stands,
The
yes.
Kazakhstans and the Kyrgyzstans and...
That's right.
And why? What is...
Well, Erica,
there?
I think it's an underserved market. Partly because there's not been a lot of media exposure, partly because there's been regulations that doesn't allow for international movement of capital, as well as free flow of talent and so on. But that's all changing. And as I saw the Middle East 10 years ago, when I was in Washington, D.C. for a few years, and people say, why are you moving to Dubai? Where's Dubai, by the way? This is 2014, 15.
Yeah.
And is there a thriving ecosystem? The answer was no. But I would say the same today for Central Asia. And I can see that coming in the next decade. So
You like being a pioneer.
I like to be in the forefront of that. I like to be a pioneer.
Interesting.
Developing the ecosystem. That's why I have the biggest joy. Because a lot of transmission of knowledge and development that I can impart in the process to the ecosystem. So that's the why.
I love that. I love that also because I resonate with it. People used to, I've been abroad for 20 years now, and people always said, like, why are you working in emerging markets? And I used to always say, as a Canadian who studied in the UK and in the US, there's nothing more boring to me than Western markets where, an investment banker once said it's managing assets versus really growing something. And I used to always say, it feels like I'm getting, like there's years where I was living in Jordan, I've worked all around Southeast Asia, and it was just so fast paced. And I think I was just addicted to it in my 20s and 30s, and I don't think I'm slowing down in my 40s. But there's definitely this sense that you are building something in this part of the world. You're not dealing with legacy systems. Yes, there could be potentially in Central Asia to some extent, maybe when you mention things like regulations, but generally there's a burgeoning population that are craving change, growth, and new adoptions quicker, and markets that are leapfrogging legacy systems. And so it just feels more exciting to be in this part of the world. Yeah.
It is, absolutely.
Yeah.
Yeah. And I get to travel and learn about a new culture. And, there's so much out there to to soak in, to absorb.
Yeah.
And at the same time, I could be of value to these communities who have not seen the maturity we've seen in other ecosystems.
Yeah.
And for me, it's being in the position to give something back to the ecosystem.
Yeah, I really love that. It feels like whatever you give back there is worth 100 times what you might give back here.
Yeah.
Yeah.
Yeah. And I think it is basically, I don't want to say it's rinse and repeat, because it feels like it, but it's a lot to do with really, there's a saying that the world is not a level playing field, but there's talent everywhere. And for me, my big why is recognizing there's talent there in these regions that deserves a chance.
100%.
And right now the field's not level, but we can help them do so. And by the way, no pun intended, but the name Silkbridge.
Yeah.
It's
like
a
the
bridge.
Silk Road.
Yes, but it's a bridge to different ecosystems. So it's a bridge to Abu Dhabi, Dubai, to the Silicon Valley. And we are building bridges across different ecosystems to allow for talent to basically prosper and scale in different geographies.
I love that.
That's the value proposition.
Are there, give us a little brief, a little taste. Are there a lot of talent there? I have this impression, and this is totally conjecture, but I have this impression that there's a lot of sort of well-educated, maybe coders, tech, analysts and that sort of capability, and maybe even some PhDs that come from the stands, from Central Asia. But perhaps they're still in this ecosystem that more are still willing to go into government or normal jobs versus kicking things off on their own. Is that a correct assumption?
Yeah, I think the way I like to describe it is that if you look at the collective, there's about 100 million people. Very diverse in terms of ethnicity, massive swaths of land. It means distances are very far. Different time zones. And so they don't have the efficiency infrastructure that you might find in North America. But they're investing and building that. But this is where I find that when you have systems or broken infrastructure or things that are yet to be built, the biggest opportunities. And the digitization of systems, whether it's a fintech solution to logistics, to e-commerce, that's what excites me. Because not the same rules that apply in the Middle East or in North America or the West, because they have those disadvantages inherent in the economy. For me, that's the biggest opportunity, as I see it, for us to go in and help entrepreneurs to build. Now, I think part of your question was the talent component to it. By and large, I find them have a very strong scientific, engineering, mathematical training, well educated, but they lack the market exposure. And so that is what we need to bring about awareness for them to take advantage of. And with this generation, they're quick learners.
Yeah. Yeah, I can
very
see
quick,
that.
very quick learners. And there's a healthy, hungry youth population. 50% of the population below 30 are.
Interesting.
Very hungry.
Okay. And very quickly, quick fire. I've got a bunch of quick fire questions for you now because we're starting to run out of time. If you were to pick the top 2-3 markets in Central Asia that you would say 1, 2, 3, these are the top ones that show the most promise right now in terms of developing a tech ecosystem, what would they be?
I'm decided on that. I'm looking at Tashkent in Uzbekistan and Almaty in Kazakhstan. Those two.
And I'm surprised not to hear Azerbaijan.
That would be my third.
Okay.
Although, to be fair with you, I have yet to go deep enough to basically be convinced.
Okay.
Yeah,
okay.
But I do believe that's probably the third, yes.
Interesting. Yeah, when I went to Baku the first time in 2017 or so, I was very impressed, did not expect to see what I saw there. And then, my old consulting career, we did hire some really smart analysts from Almaty, Kazakhstan. Yeah. And so I was also very impressed. So, I wish you the best of luck in that. But we will continue with this quick fire round. 1 sentence, 2 if you must. Okay, Vijay? What makes a perfect pitch?
Clarity.
Your biggest pet peeve when founders approach you?
Did not do the homework on who the investor is.
Everyone says that. The one slide in a pitch deck that founders overestimate?
TAM, in the market size.
Wow, interesting. The one slide founders underestimate?
The articulation of the problem statement.
Okay. Based on our conversation, I thought you were going to say the team slide, but I like that. The best cold outreach you've ever received?
The best cold outreach. This is a long one.
Okay, try and shorten it.
4 co-founders here in Dubai, ex-McKinsey's, called me up and they said they'd like to build a flying car.
Okay.
2017.
Interesting.
Met in Costa, up in Jumeirah Road. I thought it was a joke. But long story short, I invested in them.
Wow.
And they're still going today.
What are they called? We can
Blue
give them a
Flight.
shout. Blue Flight. What's the pitch?
They wanted to build a flying car, but the image I had was the Jetsons and the cartoons I used to watch. It turns out that they are basically now a commercial drone service. They've one of the 6 companies in the United States licensed to transport medical equipment and live organs across the state.
What? Wow, I love that.
Hard work for Frank Nopel and his team, but they got somewhere after 7 years.
I love that. Biggest mistake first-time founders are making right now?
Over-indexing that fundraising will solve all their problems.
Yeah, I could see that. One piece of advice for pre-seed founders in 2026. One piece.
You don't have to build a large team to execute your product. You can do it by yourself.
Mm-hmm. In the age of AI.
In the age of AI.
And finally, if you were raising today, what would you do differently?
If I'm raising today, what I'll do differently is basically I want to focus on demonstrating momentum and prioritizing revenue and having funds chase revenue, not the other way around. Means to say, founders are making a mistake today by saying, let me raise my first 100,000 to 50,000 and then let me go build customers. No, sorry. You have to go get the customers first, proof of revenue, and then come and do the fundraising.
Yeah, interesting. I have seen that adjustment recently as well. Very good. Vijay, I really want to thank you for your time today. It's been such a pleasure talking to you.
Likewise.
And I hope, and I know that this is going to be really, really just advice gold for any pre-seed, seed founder looking for investment. And I look forward to having you back on the show in the future.
Eric, thank you so much for having me here. It's such a pleasure. Under unusual circumstances, I'm sure you'll remember this day.
I have totally forgot about it while we were having this conversation. That's the point, right?
But I enjoyed the questions, and I hope your users enjoyed listening to me. Thank you for having me here.
You're very welcome.
Hey there. Thanks for joining this conversation. If you enjoyed that episode and you want to start researching potential investors for your startup's fundraising strategy, go to lucidityinsights.com and sign up now to the startup registration package by clicking the plans button on the top right corner. We look forward to having you join our future conversations and checking out our additional content. Until next time, stay hungry and stay humble.